Hello, and welcome to Accolade's market update for credit unions. My name is JD Pasula, VP of Advisory Services at Accolade. Usually I'm joined by Phil Lucas, but he's out on vacation today. This update is part of our ongoing efforts to support credit unions as we look to summarize and condense the most important developments over the last few weeks, as well as highlight a few areas of focus for credit union strategy. This recording was made on August 19th, 2021. So let's start with a recap of recent economic data. Inflation continues to run hot for the time being, and the recent CPI reading showed a 5.4% growth, which is the highest reading since 1991. Producer price indices also set record highs for that data set, which goes back to 2011. Consumer sentiment has taken a nosedive recently, and the University of Michigan survey posted its lowest level since the onset of the pandemic. Economists speculate that a resurgence of the Delta variant, combined with expiring jobless benefits and rising prices, are all starting to weigh on the psyche of the American consumer. Within the survey, consumers revealed that they are now budgeting for an average inflation rate of 4.6% over the next year, which is near the highest expectation since the Great Financial Crisis. Retail sales also moved lower for the July period, down 1.1% month over month. In jobs data, the initial jobless claims figure for last week dropped to 348,000 new claims, marking a new low since the onset of the pandemic, and continuing claims were mostly flat at 2.8 million. The key thing to look at for the jobs market remains labor force participation and whether or not we can get people back to work. A recent research piece, however, suggested that labor force participation rates have a very long lag after economic shocks, potentially as long as 8 years. And in terms of economic growth forecasts, we've started to see that those have been revised downward, and the Atlanta Fed's GDP Now model now estimates 6.1% annualized growth for the third quarter. We've seen a resurgence in coronavirus cases over the last month, but unlike the first outbreak that spread rapidly across the country, this wave is largely centralized on the less vaccinated areas of the country. For example, states like Mississippi, Louisiana, Arkansas, Florida, and Alabama have regional vaccination rates as low as 25%, and this is where the Delta variant is spreading most rapidly. As illustrated on this chart, you can see that caseloads remain below 2020 peaks across the Northeast, Midwest, and West. But in the South, we are rapidly approaching peak levels. For example, some ICUs in the New Orleans and Jacksonville areas are back near capacity, according to reports. In Mississippi, where actually the Accolade team will be next week at the MSCUA Credit Union Convention, case levels are now at all-time highs. With the spread of the Delta variant, the Biden administration is now recommending a third booster shot for Moderna and Pfizer vaccines approximately 8 months after the second dose, and these first rounds of third doses are expected to be administered starting in September. We've also seen increased mandates from employers that employees be vaccinated in order to keep their jobs, especially in the healthcare sector. This week, the Federal Reserve released the minutes from their July meeting, which revealed an emerging consensus to begin scaling back the bank's $120 billion in monthly purchases of Treasury and mortgage-backed securities before the end of the year. The minutes said several officials favored reducing asset purchases in the coming months in order to better position the Fed to potentially raise interest rates if the economy strengthens further next year. However, some FOMC members are less convinced and would like to see stronger evidence of an improving job market before tapering asset purchases. The next Fed meeting is scheduled for September 21st, and so long as the job recovery continues, we would anticipate tapering to commence following that meeting. Bond yields are virtually unchanged in response to the minutes, suggesting that the market has already priced in tapering expectations. Similarly, as illustrated on this slide, Fed funds futures are virtually unchanged, with the first rate hike not fully priced in until early 2023. The swaps market is slightly more bullish on rate hikes, pricing in a full hike by the end of 2022 and anticipating a policy rate around 1.25% by the end of 2024. Given these expectations, we would suggest that credit unions start paying more attention to the up 100 basis points 12-month ramp scenarios in their ALM packets and the impact to net interest income. All right, and let's wrap up today's presentation with a quick look at investment opportunities for credit union investors. First, a look at the yield curve. You can see it's largely unchanged over the last month or so. Rates are lower week over week. Rates had popped a little bit higher going into jobs reports and coming out of the jobs report last week, but we're pretty much back to where we were about a month ago. So we're well off the peaks we've seen in yields, which topped out in early April of this year, where we saw the 10-year right around 1.75%. 1.25% seems to be where the 10-year is coalescing lately, and it's hard to see reasons for why that would change in the near term. In floating rates, we're seeing floating rates to be very steady. 1-month LIBOR is back at pretty close to all-time lows at 9 basis points. Same for 3-month LIBOR at around 13 basis points. That's just off of all-time lows. You can see that in terms of the CD marketplace, there are some opportunities for credit unions with smaller portfolios where you can still pick out some CD specials. These rates are indicative of the average cheapest 5 issuers across the brokered CD marketplace. And we've been able to pick out some CD specials at 2 years and 3 years that have been fairly attractive. But I'd say the majority of this market is right at Treasury rates or even lower than Treasury rates. Callable rates haven't changed a whole lot week over week. You can find 5-year callables close to 1%. We've seen certain structures that are right at 1%, 3 years around 50 basis points, 2 years around 23 basis points, but not seeing a whole lot of new origination in the 2-year sector. It's really in 3 and 5 years. And then in terms of PAC CMOs and well-structured CMOs, we're seeing 3-year average life investments around 1%, just below 1%, 5-year average life investments close to 1.4%. Our next update will be released on Thursday, September 2nd. Accolade is a registered investment advisor, and I'm required to ask you to review the disclosures on the last slide here. We believe that credit unions are uniquely positioned to improve the financial lives of their communities, and doing good work for them can lead to relationships that will last a lifetime. Wishing you all peace and health, and talk to you soon.